Okay, we're live. Welcome back, everyone, to RWA Week. I'm Polly Speck, strategic advisor at RWA Week, and today we are tackling one of the biggest questions facing tokenized finance. Can we really have yield, safety, and composability at the same time, or is that asking for too much? As billions of dollars of real-world assets move on chain, the industry is discovering that every benefit seems to come with a trade off, and more utility often means more complexity, and more composability can sometimes mean more risk. And to help us unpack this trilemma, I'm joined by, for now, two, but soon will be three outstanding guests who has been working at the intersection of traditional assets and blockchain infrastructure. We have Sudip, COO at Table. Please correct me if I'm wrong in
Yeah,
pronouncing
we
it.
say STBL.
STBL.
Yeah, connotation of yeah.
Bringing deep operational and marketing insights from the stablecoin and tokenized asset space. We also have David Dye, Chief Strategy Officer at Faris, who is focused on building the infrastructure needed for scalable on-chain finance. And soon we will have with us as well Michael, a co-founder at Shift RWA. Over the next hour, we will explore where the real risks sit, how legal and technical frameworks are evolving, and whether permissionless finance and institutional capital can truly coexist. So let's jump straight into it. For now, dear speakers, dear panelists, feel free to introduce yourself to our guests. Give us a little bit of a background of yours, how you end up in Web3, how you end up building what you're building right now. And Sudip, let's start with you.
Sure. Thanks, Polly. First of all, thank you for having me here. Yeah, I think it's been an interesting journey for me so far. I started off in banking, investment banking, then moved into fintech, and then post fintech got a little more degen and moved into the Web3 side of things. How the transition really happened for me. So it's been like about 15 years overall, and why the transition happened from banking to fintech and fintech to Web3 particularly was because my focus and my area of interest, as well as what I was working on, was more on the structuring side, financial product structuring. So what you see typically in trade finance, and as you move into fintech, there is a lot more that can be done and leveraged with technology. And then moving into Web3 was around 2021, when just before the, I think just around the DeFi summer, and a lot was happening on, as everyone knows, on the DeFi side in terms of lending, borrowing, and many interesting products were coming across. Things like staking were also pretty novel to me at that point in time, and there was a lot that I thought that could be added in terms of value when you get what everyone seems to want to do, and what people have been doing pretty well over the last few years is getting traditional liquidity into Web3 and riding the volatility. And then it's been 5 years, gone through two cycles now, I guess, and yeah, there's a lot to build and do. So thanks again.
Wonderful. That's a great journey, Sudhir. And I think it makes a lot of sense. You started in investment banking, where you learn how the financial system works, then moved into fintech, where people try to improve it, and finally into Web3, where people are trying to rebuild parts of it from scratch. I would say it like this, but that's quite a progression. And I also like that your move into crypto and to Web3 wasn't just about chasing the latest trend, but about seeing the structural opportunity where your experience could actually add value. And it's interesting that you came in around 2022, because that was a period when the industry was being tested and forced to mature, I think. So those kinds of experiences often teach more than a bull market ever can. So it's great to have someone with both traditional finance and Web3 experience helping shape what comes next. And David, I'm happy to hear your journey as well.
Absolutely. Thank you so much, Pauline, for having me. And I'm everybody glad to join this call. I'm also sharing a little bit similar background as Sudip. I found a lot of our colleagues in the RWA space actually also coming from the banking background. So I started my career within a PE, and then later on went to investment banking, had an exposure in the different areas, crossing from equity derivatives to structured financing, later on to other debt financing, and then later on to a fintech. So kind of similar paths. But I do see that the reason that there's a lot of friends sharing this path is because I think we've been trying to do in RWA, and then what people has been building in this space is actually very similar to the structured products, very similar to what derivative trading, and similar to other areas in the investment banking, but just in a much more efficient way, a much more with a much more advanced attack. And then there's a lot of more innovations in this space too. So it's very exciting. I've been in this space since 2019, and then later on full-time joined this space from 2023. Starting from there, starting to focusing on structuring products within the RWA space. So thinking initially start thinking about the custom permissioned token, and then most recently particularly focusing on the vault economy. So I feel like this space is rapidly growing despite the market conditions right now. Some people see that as a bear market. Some people see that as a perfect time to build. I think at the end of the day, it is. I wouldn't say that it's perfect, but it's just that now it's the time actually to think about what the product really feed the market, and then how do we polish that market, and then suitable for the specific need. And definitely wanted to spend more time with you, with Sudeep, with everybody to further explore this area.
Awesome, awesome. Thank you so much, David. And it's pretty interesting how often we hear this story from leaders in the RWA space. And you started in equity banking, debt financing, then fintech, then eventually Web3. And in many ways, that mirrors how financial products themselves have evolved over the years. Thank you for mentioning this. I noticed it as well, but I didn't think it that way. I think that's why people with traditional finance backgrounds are playing such an important role in this sector today. So you understand not only how innovation works, but also how capital markets actually operate in the real world. And I also like your point that many of your peers followed a similar path. That's cool. Getting involved back in crypto in 2019, I think that gave you a chance to see several market cycles, and it's pretty valuable because this industry can be very tough teacher sometimes. And since 2023, we have seen enormous growth in tokenized assets. So focusing on structuring RWA products at this stage feels very timely. It's great to have someone who can connect both worlds as well. Awesome then. I'm Web3 native, so I'm very interested always to hear more stories from traditional finance backgrounds, and I love to learn. I love to see some new things and how people approach different problems. But today I will torture you guys with several tough questions. I hate simple questions. I like to skip them right away. So let me shoot. Does chasing DeFi composability inherently destroy the low risk profile of underlying real world assets? I mean, this is where crypto people sometimes get a little bit too optimistic, but I would love to hear your thoughts. Sudeep.
Sure. Yeah, no, I think it's an interesting question, and I would like to kind of break this down into two parts. So before we get into maybe the DeFi composability and low risk profile of RWAs, let's take a step back, and probably when we all started, like I guess when David started, when I started in crypto a little later, there was a lot of there was a lot happening on the DeFi side in terms of, say, algo-backed stable coins. We all know, for example, what led the contagion in 2022, right? So at that point in time, you actually had assets which had questionable, I would say. I wouldn't necessarily put it in a way where I would specifically pinpoint to a particular area, but we all know that this didn't work out as planned because of the questionable underlying, right? And that, I think, kind of gave, in some way, directly or indirectly, an impetus to get more RWA on. And as we see now, we already see the trend in terms of RWA being distributed. I mean, you have the BlackRocks and Franklin Templeton securitize and everybody else kind of getting this RWA on, right? So at the first level, if we break it into two levels, the first level is you have a stable asset technically. Let's say here, let's talk of stable assets for a moment, and these stable assets are backed by strong collateral, say money markets, right? So you have a low risk profile where you have something that you can validate with good custodians and with good protocol architecture. You can validate the underlying. Now comes the second part, right? Second part is in terms of what can be done with that stable asset in a DeFi ecosystem. So of course, I mean, there are different risk profiles, and everyone has an entitlement to, select, as long as people are aware and educated of the risk profile, not creating a contagion in the industry. This is where the guardrails come in from, the protocol or the end use case. So for example, capping leverage or having certain limits or thresholds of managing counterparty and credit risk is effectively what comes into the picture. So just to put it in a maybe simpler perspective, if you have a stable asset backed by money market and you're using it on to borrow some other assets, or effectively trying to create a looping strategy, you need to be able to cap, or you need to be able to have a metrics at the background, risk matrix at the background, that effectively caps out the leverage at a certain number, right? These are the kind of checks that need to happen at the secondary level. So to answer your question, inherently, DeFi composability can reduce the sort of risk profile of a stable asset, can increase the risk profile of a stable asset, but at the same time, it's not, I would say, necessarily the case, as long as there are proper guardrails in case to do that. And that's where effectively the end users come into picture. I think that's just my little perspective here.
David, do you agree with Sudeep?
Yeah, absolutely. I want to echo what Sudhi mentioned about we should take this into the different parts. Particularly, I mean, I'm just thinking from the underlying RWA's low risk profile versus the DeFi composability. I think this are actually two separate things. When we think about the DeFi composabilities, if we're just purely thinking about make it more suitable for looping, which is the extreme case, then maybe yes. In some of the case, people does prefer higher yielding and then occasionally a higher risk profile for the looping use cases. But however, I think the risk profile of underlying assets can be irrelevant to the DeFi composability. So just take a money market fund, right, as an example. So there is a different type of money market fund out there. From different issuers. Some of them are extremely suitable for DeFi. Some of them are still relatively basic and then need some work. And then they all money market fund. And then, of course, some of them are very large from some reputable issuers, very established for decades of track record. So I believe it's not necessarily the case that the increase of the DeFi composability would increase the risk of the underlying assets. Also, another thing I would say is that a lot of people would like to build stuff on safe asset, right? But the safe doesn't mean it's there's no risk. I think when the people think about the safe, it's really like what's the risk adjusted return on that? What's the balance between the risk and the return? Does that underlying assets has the proper risk mitigant? Does the data is transparent? Is there proper guardrails, as Sudhi mentioned about? People are not always looking for low risk asset for DeFi use cases. Actually, from our perspective, Pharos is an RWA focused chain where we constantly originate, structure, and distribute RWA assets on this chain. So we work with the LPs communities, working with different channels, working with the market very frequently. And what the things we learned is that there's definitely investors out there looking for has a relatively higher risk appetite. They're actually looking for high risk profile underlying assets, as long as that the underlying assets is properly mitigated by different, for example, there is a proper credit enhancement, or the data is transparently and properly disclosed, and then they can have their like the real time, for example, risk monitoring on this asset. Then they're okay with the risk, and then this will be reflected in the risk premium that people would charge on the DeFi products they will invest into or participate into. So at the end of the day, I think increase in DeFi composabilities will not destroy the low risk profile on the underlying.
Mhm. Okay, okay. I hear you both, and I think that you both make a very important distinction here. Sometimes people hear the word safe asset and immediately assume safe system, but those are not always the same thing, right? For example, a tokenized treasury bill or a money market fund may have a very low risk underlying asset, but once you start building different strategies around it, the overall risk profile can change. But that's not necessarily bad. It just means investors need to understand where the risk is actually coming from. And I also like David's point that even the safest asset still carries some level of issue or operational or market risk. And in finance, there is no such thing as a completely risk free lunch, although many people keep looking for one. Though what seems to matter as well is transparency. If users can clearly see the underlying asset and understand how it is being used in DeFi, I think that composability becomes a tool rather than a threat. Though on another point of our discussion, how do you think what kind of a technical and legal architectures allow tokenized assets to act as a high quality collateral without triggering a risky re-hypothecation? I love this word because it's very long, but anyways, it's an interesting question, and I usually by myself don't have a single answer to that. Feel free to go first.
Yeah, I'm happy to go first, unless I let maybe David want to if he wants to, but otherwise I'm happy to go. Okay, so I'll give you my perspective, and I think great build up to the previous question. So yeah, so effectively what we're looking at is we're talking of two things here. We're talking of a legal structure and we're talking of a technical architecture or structure to support that. So of course there are a lot of assets out there which are being tokenized right now. The simpler ones are um, treasury, tokenized treasuries, as we see. Obviously, we keep talking about it. But I think the first important part is the structuring. And of course, we've seen multiple structures that are there in terms of how, what sort of subordination of the assets that you would potentially see, what are the kind of credit, you know, options that are available effectively to like a first loss deficiency or effectively the quality of the asset. So you first go into the quality of the asset that you are trying to analyze, and effectively how are you able to ring fence the asset. It becomes the most important thing. If the legal structure is clear, and this is where a lot of assets being tokenized are using special purpose vehicles and accredited trustees, custodians, because they are the first line of defense, at least as far as the asset is considered. Then the second part comes in is which is where I mean us at STBL and we've been doing quite a bit in terms of how do you kind of ensure that these assets that are already tokenized or in the process of being tokenized are effectively being locked in as an underlying for whatever other purpose that could be there. It could be for issuance of a stable asset, or it could be as a tokenized asset itself. And this is where I think you have industry standards like ERC 20 to begin with, ERC 4626, and so on, which potentially enable, say, indexing of these underlying assets, and then being, in a way, locking it to ensure that they cannot be technically used or misused, and they are being used only for the use case, which is effectively transferring these assets on chain to select parties. There are also specific rules that need to be set in place in terms of whether they are freely permissionlessly transferable or they are permissioned, so that the intended recipients are actually eligible to receive these assets or not. And then, of course, the third aspect is on monitoring these assets with oracles and, of course, these off-chain custodians. So the latency of oracles, and this is where some of the other industry participants also come in, where you have like the chain links and the redstones that effectively work with parties like us to enable having as latest oracles as possible. This is easier for certain instruments like tokenized treasuries, possibly harder for less liquid instruments that are being tokenized. So as long as there is pricing and there is certainty about the underlying, which is there, effectively, we need to know what the value of the underlying is, whether the underlying is there, and whether it is used for the same intended purpose. These are the three things that potentially create a strong structure for enabling any asset to be tokenized and used efficiently. The more you're able to do this, the better the distribution for the asset would be.
David, thank you, Sudeep.
Yeah, also agree with Sudeep that we also look at this from the different like two separate angles. So from the legal perspective, I assume probably people, some of our audience are still remember Lehman or like MF Global, right? So there's in a TradFi, there's always regulations that prevent this type of risk, or some types trying to avoid this type of risk. I mean, if you're thinking about the Reg T or like SEC's 15C3, so those are the regulations that will actually help to mitigate this type of the risk. But on-chain world right now, when everybody's thinking about the vaults, right, or thinking about other type of permissionless token, there's no such regulations compliance to prevent or to penalize this type of practice just yet. But I think that thing would change in the near future with the I guess enhanced clarity and then also the compliance environment. I think this type of risk will naturally got mitigated with the involved legal architecture. But before that, and also I think separately, I think technical features is also a great way to prevent this, starting from like a proof reserve, right? So there's a lot of proof reserve solutions out there, but at the end of the day, they're serving the same purposes, is to let the users, particularly in DeFi, where the assets will be wrapped multiple times, they knows that where the underlying asset sits, and then what's the status of the underlying assets. And then they can add on-chain computations, adding automations, adding many different condition-based or maybe other like intent-based checks on that like underlying assets via the proof reserve to prevent any type of like misuse or any risky practice applied to the asset. For example, there's over-minting protections that you can utilize. For example, if the underlying assets in that showing in the proof reserve does not comply with that initial intent. So that can actually well mitigate some of the risk that in here. So I think I would suggest that for the some institutional level of the RWAs and a lot of assets that we know that will have a very high DeFi utility, that thinking about how to prove the original assets, how to utilize the proof reserve, utilize the different the technical solutions to enhance the data transparencies, to enhance the guardrails that apply to the underlying assets, so that the risk here can be actually minimized.
Okay. There are a lot of thoughts. I was taking notes to be able to have some comments on that. So I really like that both of you are looking at this from both in technical and legal sides, because the problem cannot be solved by technology alone, unfortunately. Sudeep, your point about custodians being the first line of defense is critical. I think before we talk about collateral utility, we need confidence that the underlying asset is actually there and properly secured. And David, I think that the comparison between TradFi regulations and DeFi worlds is a very important one. My dream is to organize a panel with different regulators from Hong Kong, from Switzerland, from Europe, from US, to be able to talk to them on a weekly basis about the updates on regulations, because we really need it. Traditional finance spent decades building layers to prevent the same collateral from being reused too many times, and often after learning some of very expensive lessons, especially during 2008 crisis. And on a blockchain side, I think that proof of reserves and smart contracts restrictions and Oracle monitoring can help create the same trust. in a more transparent way. And on another note, what I find interesting is that some of the strongest RWA structures combine regulated custodians and legal protections and on-chain verification rather than relying on just one layer. It's also a bit ironic that Putin started by trying to remove intermediaries, yet some of the safest designs today look wonderfully boring. Though when it comes to collateral, boring is usually a very, very good sign. Though, how do you think if an on-chain protocol suffers a smart contract exploit, how do the off-chain legal wrapper determine who actually bears the financial loss?
Yeah, so maybe I think I have a few points here. I think it's a pretty bad situation to be in, obviously, but it's a reality that we see in the Web3 world today, where the first point to consider is first the protocol itself, because realistically, that is the one that is um, doing a fair bit of complicated work on chain, and there are many possibilities of attacks and exploits that could happen at the protocol level itself. We've seen this time and again. I think we see it once a month on an average, where you see exploits happening not just on some of the smaller protocols, but I think it's happened to some of the best. And of course, the security is evolving. This is where I think having a good structure for auditing protocols becomes very important. Having the right kind of bugs identified periodically, just as a housekeeping, become important from a protocols perspective and from a responsibility standpoint. But I think the first point to consider there is how to effectively identify the exploit that has happened, and if there's a way to retrieve. And of course, on chain there have been ways to effectively freeze and claw back assets, which is what protocols have done. If that is not identified, or if it's weak and there is a deeper rot which is visible from the asset itself, underlying asset itself, that's when you would go down the off-chain route, which is beyond the protocol or beyond the Web3 itself, and try to investigate the underlying asset, including the custodian and the structure. If there is some legal recourse, which of course becomes more complex because it depends on various factors like jurisdictions and the financial liabilities. Some of the jurisdictions, of course, are friendly from a WASP or Web3 perspective, but there are still quite a few who have a weak link there, and it may kind of become a long, prolonged process. So both of these, if there is some way possible, it gets harder as you go out of the protocol level, to be honest. And finally, of course, if none of these two work, then unfortunately, the reality, what would be bad for the industry, would be that it would be a loss that the investor would ultimately have to bear. But it's definitely an area where I think both the asset originators as well as the custodians and the protocol itself need to work very well and be pretty transparent. Like I think David mentioned about proof of reserves, and this is where I think latency of oracles, proof of reserves becomes very important in terms of unencumbered assets as well. So yeah, I think just exercising caution and building on operational risk becomes extremely important as we look at this.
Thank you, Sudeep. And I think it's very important reality check. We all get excited about innovation, but smart contract exploits are still one of the biggest risks in the industry. And unfortunately, they are not rare events. That's why audits and monitoring and strong security practices are not optional anymore. They are a part of the product. And I also like a point that identifying the exploit quickly and having a clear response plan can make a huge difference in limiting the damage for sure. In tokenized, like a tokenized asset may be backed by something very safe in the real world, but if their legal structure is unclear as well, confidence can disappear pretty quickly. I see that Michael joined us. Yes, welcome back. Hope you're doing
I'm
great.
very sorry for being late. Back to back here. I had a strategy meeting that refused to end. So here I am now.
Yes, so
Happy to
no
join
worries.
in on the discussion. I hear you guys are talking about security and transparency and proof of reserves. Maybe you want me to kind of jump in with a small intro first?
Yeah, would be great if you can give a little bit of an intro about yourself, and later on we can continue the discussion. I will repeat the question that we were discussing previously.
Absolutely. All right. Hi, I'm Michael, 46, one of the co-founders of Shift. Been in the tech industry since 2001 and in the Web3 space since 2017. Have 3 exits under my belt, and also was a bit in the TradFi business, was CTO of a mortgage company, which raised over 200 million from the leading institutionals in Israel, where I live. Since 2022, I'm co-founder of Shift. Shift is an RWA issuer, bringing fully backed stocks, bonds, ETFs, and other financial tools as native cryptocurrencies. Currently launched on Solana with about 41 million TVL, and very happy to be here today.
Awesome. Thank you so much for joining us, Michael. I know how hard and how long these strategy meetings can be. I think that we all can excuse Michael for today. But yeah, 3 exits, TradFi background, exactly right in the place to the panel. We have all the panelists here with the traditional background, which is wonderful. I love to learn from people like you guys. Though I think that we can go back to the question that I asked previously to the panelists. David, maybe you can say a few words. I will repeat the question so Michael can hear it as well. If an on-chain protocol suffers a smart contract exploit, how do you off-chain legal wrappers determine who actually bears the financial loss?
Gotcha. So I'm not a legal expert and definitely not in a position to provide any legal opinions on that. But based on my experiences since recently, there's unfortunately, a lot of smart contract exploit incidents. I think it's an ongoing issue that, right? So people trying to determine who's actually bearing the responsibility and how to recover the cost. And then also it seriously damage like users and investors' confidence in on-chain finance, because there's no clear path, like who will bear the liability, and then how do they basically get their damage or get their fund back. So there's a lot of I would say nuance here. One is that whether that this is like truly like DeFi, or this is kind of a CDFi, or this is a truly decentralized, or there's some type of centralized in here, and still, if this is like, for example, if this is a DAO, right? So on this different jurisdiction, people treat DAO differently as well. Like in some of the jurisdiction, you just simply can't chase up anyone within the DAO, but in some of the jurisdiction, you can. And also, if this entity is like a foundation or LLC or some type of limited, like a corporation, then you're still going after that off-chain like legal wrappers. And then also in some of the protocols, depends on how the interface are built, right? So when you go into a specific website and launch the app, maybe there's a screen will pop out and say this is a damage waiver or something. They will structure the wording differently, but if you accept that term, then basically you bear like 100% of the liability. But same thing, whether that is enforceable, that is varied by like jurisdiction by jurisdiction, but at least that's a common practice we've seen. I'm sure when you try the different dApps, there's some type of screen will pop up and ask you to accept some terms. And in that, like the term of use or term of service, you will find some like damage waivers or some liability waivers language in there. So depends on how they structure that. That's another way to shift it. And then we also see that there's a common practice that the protocol's foundation the protocol's treasury will absorb the damage. So if they wanted to continue bring back that protocol, rebuild confidence in the market, and hoping the churn rate is not that too high that the user will stick with them, they will quickly come up with like the mitigant plan by, for example, offer. So either all or a certain percentage of the damage covered by their treasury. That's also common practice. And then there's some of the protocols actually acquire some insurance, right? So there's insurance. It's actually a great way of risk transferring. And then that also gives the users, the investors, a confidence to use this product because they know there's a financial backers there if there's anything happen. And there's many other ways, but I don't think there's a common like the practice just yet because people are trying the different routes. But as long as that people are trying, right? So then I think right now and then in the near future, this will be greatly improved.
Okay, thank you, David. Michael, what are your thoughts? Do you agree with David?
First of all, great take from David because he really took it deeply and widely. The thing is not one size fits all. And so smart contracts are a danger and there are different risk levels. But for instance, a lot of these stock tokens can be clawed back immediately or can be stopped or can be blacklisted. And, right after they were stolen, if you take it, if you're fast enough, you can actually save most of the customer's money in some cases. In other cases, of course, USDC, USDT, and risks like that. We've seen a few RWAs companies get hacked and disappear. One of them was Remora, which is a very sad case of a lot of money just being stolen. I don't know enough details to say by whom or how, but fact is, it's gone. And the point is, people have to be very diligent. We've been working on our security systems for 4 years. We have former Army experts and cyber experts that are the only ones that we allow to touch the basic core systems. We've gated them away from the internet at all. So our tokenization engine is just completely offline and nobody can touch it. It's completely, faceless or, unattackable, I'd say. Nothing is really unattackable, but mostly unattackable. And so you really have to build things in a very, very safe way. And then once you're out there, there's so much more because you have partners and you have bridges and you have other collaborations or composabilities and layers upon your product. And then maybe they have a bug, they have a hole. And through there, somebody can just, take all the funds immediately. And you did all the work you did audits, you did, whatever the right way is to do it, let's say for your company. Even if you did all that, you have to go really deep in due diligence to your partners and whoever is using your products and let's say either being a distribution channel or standing in the middle between me and the customer. That has to be very, very safe as well. So there's an entire chain here that needs to be checked, audited, tested. And actually, the planning part is very important. If you plan it well and you have enough fail safes and stop losses and let's say alarms and triggers that everything in your system 24/7, you can mitigate and stop most of those issues even after. Now, you can get 5 companies to audit your smart contract, but in real life, auditing is an ongoing event, and a lot of bugs are found months after contracts were deployed or protocols were deployed, years even. Microsoft Windows still have critical bugs found every day, right? And updates being sent. I'm talking about the most usable software on earth, right? So we don't expect everything to be perfect, and that's why we run these ongoing bug bounty programs. But it's our responsibility to keep our customers' money safe, and Web3 is learning this the hard way, sadly. We're very, very avert. We really do so much to, keep our customers' money safe. It's our number one priority in the company. Sorry for taking so long, but I have a very, very strong conviction on this.
All good, all good, no worries. I think both of you, David and Michael, highlight why this is such a difficult question for the industry. David, your point about jurisdiction is really important because the answer can be completely different depending on whether we're talking about a DAO or a centralized operator or something in between like CDFI. And Michael, I like your focus on preparation because once the exploit happens, every second matters, and having these alarms or monitoring systems, emergency procedures in place can sometimes be the difference between a small incident and a major disaster. So the uncomfortable reality from my perspective is that many investors assume someone else will observe the laws, and then an exploit happens and suddenly everyone starts reading illegal documents for the first time, though in practice who bears the laws often depends less on the blockchain itself and more on the legal agreements as well. um, Governance structure and responsibilities defined before anything goes wrong. That's why resilience is not just about writing good code, but it's also about having very clear legal frameworks and a well prepared response plan when things don't go as expected. Yeah, one day I will torture all the legal members from all the jurisdictions, I promise you all, so we can have all the answers on our table. But another interesting point that I wanted to discuss, a pretty debatable question: can true permissionless composability exist for RWAs, or will institutional compliance inevitably force these assets into permissioned or like wallet gardens?
May I?
Yeah, sorry, please go ahead, Michael.
Thank you, Sudeep. Thank you. I'll try to be quick. Both will exist. Easiest answer. Both will exist. The worlds of permissionless exist already. Licensing offshore allows these things. Nobody's going to stop that. And institutionals will probably not be part of this in every jurisdiction. Once again, some will be able to play, some will not be able to play these ungated, unfenced, permissionless places. And Uniswap and Securitize just have a new walled garden, and BlackRock have their walled gardens, and Ondo have their walled gardens, et cetera, et cetera. But look, Ondo are both in locked and unlocked places, right? USDY, OUSD started as very permission products, and they're now becoming more permissionless. So we see this, I won't say the wall is broken, and it can't really be broken as long as KYC and banks and these laws will continue to exist, and they will. So there will be a lot of this, and I see a lot of this as well. And there's trickling between them. Some is legal, some is illegal. I'm not a lawyer. I'm not one to say what is allowed. And there's so many jurisdictions and laws. There's not real clarity. But once again, these disclaimers exist on the website, of course. No US citizens, no UK citizens, et cetera, et cetera. And then you actually look at the demographics and you see everybody's buying from everywhere. So actually, these disclaimers sometimes make people even more FOMO-ish. I have to say, it's funny. But as a person, I'm against geofencing. So, people have the right to buy, and they should read disclaimers. But to touch on a previous point, if you do have a disclaimer and there is kind of a problem with the DAO, and you do need to get your funds and you have to go KYC, but you're from Iran, US, whatever. It's funny that Iran and US citizens can face the same issues when coming towards KYC and a crypto object, right? But that's the reality of it. So once something wrong happens, for example, we have private segregated accounts. Neither us or our banks can touch those funds in case of debt. But the actual user, if he wants to actually get that stock, he will have to go with KYC. And what if he doesn't pass it? What if he can't? So it's really tricky, as David mentioned. So just want to touch back on that. It really, it annoys me how fragmented the world is, how crypto seems like a unified thing. But when you come down and break it down to, oh, I want to take that to my bank, I want to off-ramp it, I want to KYC, you get the complete breakage of the unification. So stay on crypto if you want to keep it easy. Institutionals are very, very crypto curious right now. And thing is that somebody smart told me 10 years ago, the VPs of banks were, 60, 70, whatever, and they didn't know crypto and they didn't know what crypto is. But right now, SVPs, VPs of banks are the same age as we are here. The VPs and the C levels of the crypto companies, we sit and have beers together. We have the same portfolio conversations. So you see the trickle. It's moving every day. So our banks and partners are asking for more Web3 products, and they have the way that they need it according to their regulation. But it's moving day by day. More and more money is moving on chain from these institutionals, and it will continue because of the capital efficiency, not because they're in love with it. They're not in love with anything. They're in love with making more money faster. That's it.
Okay, noted. Sudeep, do you agree with Michael?
Yeah, no, I think definitely agree. There is you probably can't have one of the two, and I think Ondo USDY is a very good example, because if you know USDY, you can mint USDY at the same time. You can have a way to swap into it. Of course, there are some terms and conditions, but yeah, that's one. But honestly, like I would think of this as, rather than calling it maybe a walled garden, I would just think of probably calling it like permissioned composability with open interfaces in a way. And I'll tell you why that's the case. Because what's going to happen now is, as we all know, and we are all battling. I mean, for us, like even at STBL and everywhere else, everyone's talking about how things are going to look post, say, the Clarity Act coming in. And there are two things which I think are inevitable for everybody, including the Uniswaps of the world, is AML and KYC is going to come in some form, in my view. There may be some ways, or there may be some time to kind of find a way around it. And I think maybe rightly so, because at the end of the day, everyone wants the good actors to participate. And you don't want to be kind of going through the same points that might come through in some or the other connotation on the previous question that you had. So the good thing is that with this kind of, I would say, open architecture in some way, with maybe some rules, you might possibly have a way to have better distribution velocity for RWAs. The use cases that we are building, for example, with what we call as ecosystem specific stablecoins on STBL. It's effectively that you can have somebody minting stable assets with RWA collateral, and then there could be certain rules based on who is minting and potentially how the stable assets are effectively circulating within a certain ecosystem. And everyone will find their fit and size, I think, at the end of the day. So I think, as again Michael pointed out, everyone will find a way, and everyone legitimately wanting to use it for a right cause will find some sort of use case. And at the end of the day, hopefully we have the jurisdictions and all the banking partners supporting us, and I guess that's where the business lies for a lot of them as well. So yeah, I think and lastly, I think just one more point from my side is, I don't think anyone is going to ever try to make a full stack. We're all trying to effectively build on the best products that are there, for example, for AML, for KYC, for custody, and then effectively find the right sort of blend somewhere down there, because everything is there on the infrastructure side. It's just about trying to optimize it in the right way.
Oh, yeah, David, sorry, I muted you for some time because there were some noises. We can hear you now.
Oh, cool. Yeah, but sorry about that. So just wanted to quickly comment on what Sudeep and Michael mentioned about. So I think, first of all, as Michael mentioned, the true permissionless already exists on chain on many of the RWAs. I think it's more of a choice of whether the user chooses to have so-called the permissionless or permissioned, or what type of the guardrails that they suit for their need. For some of the investors, they actually prefer some institutional compliance to be checked, and then some of the even off-chain security measures to be applied. In that case, they have to sacrifice some of the composability or their flexibility just to trade for that extra like security measures. So I think the both thing will exist, targeting a very different group of users and for the different purposes. And we'll see like more and more of different permissionless on chain.
Well, I think that all of you are in an agreement around this question that the future is probably not going to be fully permissionless or fully permissioned. Michael, your point is very practical. Compliance requirements like KYC AML are not going away, especially if institutions want to bring large amounts of capital on chain. So Deep, I really like the phrase permissioned composability within open interface. I will steal it. That's cool, because it captures where much of the market seems to be heading. And we already see examples where assets have certain access controls but can still interact with the broader ecosystem, and that feels like a realistic middle ground. David, your point about choice is very important as well, because different users and different use cases need different levels of openness. Some investors will prioritize accessibility while others will prioritize regulatory certainty, and both markets can exist side by side. And the funny thing is, uh, for years, crypto debated whether one model would win, but it increasingly looks like the answer is both. And that might actually be a sign that the industry is maturing. I think that I'm saying that the industry is maturing in every panel, but well, it is. I think that we are out of our time on air. We have around 4 or 5 minutes left, and I think it's time to say thank you to everyone. First of all, thank you for all the bright thoughts, and I really enjoyed the conversation here. Sudeep, David, and Michael, maybe you have some updates on the product side that you would love to share with the audience. I think that listeners and viewers would love to hear and follow the journey of the projects that you're building. Feel free to go first, Sudeep, maybe you.
Thanks, Polly. I think David and Michael, it was great to participate on this with you. And yes, I think we're trying to solve this problem of, I mean, I would say problem in a positive sense, where we are trying to effectively improve the distribution of RWA through stable assets, which potentially gives at STBL potentially gives an avenue for institutions to own their ecosystem in a way. We're launching RxUSD on XLayer, which is using a blend of two high quality RWA, which is USDG on the treasury side, a tokenized treasury side, and then we have HL scope issued by Securitize, which is on the private credit side. So it's a 70-30% split, and we hope to kind of revolutionize the way these RWA assets are used on XLayer, which is super efficient, and having some use cases coming up on that in the next month. So really looking forward to your participation, your feedback, and also we are continuing to scale up on our stable asset USST, which is now going to be across two chains, Ethereum and Stellar. We're just launching on Stellar next week. So I think exciting times ahead, and would love to collaborate. And again, thank you once again.
Thank you, Sudeep. David?
Yeah, absolutely. So I think one thing clear is that we are still in a very early stage of RWA, even though RWA has been the concept existing for years. But I still feel like throughout, for example, our questions today, one thing for sure is that there's a lot of uncertainties, there's unclear, but there's a lot of opportunities for us to build. So which I found this space is very exciting. And then definitely wanted to see it continue to see how the pharaohs and then as RWA focus the chain can help or contribute to this larger community, and welcoming everybody to if they have any thoughts or ideas or like to build, let us know. We have the grant program, we have incubators, we have different resources to support the development of this space, and we're looking forward to working with everybody. So thanks again, Pauline, for having us.
Thank you, David. And Michael, I know that there are a lot of different updates.
Yeah, sure. First of all, thanks Sudeep, thanks David. Great to see smart panelists with us, and I love that the space is maturing and getting to a place where real professionals are actually implementing their knowledge from previous, TradFi and real, let's say, more substantial regulated areas to bring us a safer space. So kudos to you guys, and much success to Pharaohs and to Stable. Love you guys. Other than that, yeah, keep an eye on Shift RWA. We've just launched the SpaceX Leverage ETF long, and we're going to launch the short one as well, as everybody wants to short it now. You know how it is. So we continue to launch more products as we move on. We're working on a yielding stable. We're working on a vault. We're working on multiple other projects. So keep up with our socials, and thank you very much. Thanks for listening.
Awesome. It was a fascinating discussion. And from my side, I think that today's conversation made at least one thing clear, is that tokenizing assets is an easy part, and designing systems that balance and safety and utility and openness is where the real challenge begins. And we heard different perspectives on composability and legal accountability and economics of on-chain capital. There was one common theme through the future of RWAs will not be decided by the technology alone, right? It will depend on how successfully we connect blockchain infrastructure with legal frameworks and institutional requirements, of course, and real market demand. I would love to express again a huge thank you to Michael, to David, to Sudeep for sharing your expertise and for not avoiding the difficult questions. These are exactly the conversations our industry needs as tokenized finance moves from experimentation toward mainstream adoption. And thank you everyone for joining this panel as listeners and viewers. It was Paulo Speaks, strategic advisor at RWA Week, and your host for this session. Enjoy the rest of the day, and we'll see you on the next one. Thank you, everyone.